Splashcreen. Wake up, motherfucker.
Yo, what's up, guys? All right, let's go. Gonna have to have a lot of stuff to talk about. Yeah, all right. All right, been watching some Bruce Fraser's piano. Yeah. Okay, good. You're practicing, you're learning. Good. You ever done both PNF production? Yeah, I've done the PNF before. I haven't compared the two though. I haven't got around to doing that stuff. I mean, I guess there are two different ways, right? One uses the ranges to measure stuff, while the DeMark stuff, it's basically based off of Fibonacci. You know, the Fibonacci sequence, golden ratio patterns type stuff. DeMark is more like woo-woo, right? Magic. Like he bases everything on just the patterns that he sees, like. And you know, there's no logic to it. It's essentially like you have to base, if you believe in DeMark's system, like the counting, the way he does it, you have to believe that there's a pattern in the universe that somehow will be reflected in the stock price, right? So that's a lot of new age thinking. I mean, he's not going to say it like that, but that's essentially what it is. You assume that the universe has a pattern. You see a spiral galaxy, you see a hurricane with a spiral, you see all these things. You assume that they will repeat in shapes and forms that you'll see in a chart. So human behavior will also be governed in that manner, right? So that's all it is. The reason I like the DeMark stuff for doing that, though, is because I told you before, the 1, 2, 3, 4, 5, the Elliott wave. The problem with Elliott wave is that it's subjective. Where is the top and bottom of the waves, right? You could look at it and it's like a cloud. Anybody could pick where the top and bottom looks like in a chart and say, hey, that's a 1, 2, 3, 4, 5 right there. But then it's not true. Like then all of a sudden the market goes up and down in a different way than what you predicted, and it doesn't work. The DeMark way at least tries to make rules. Like you can't call it a 1 or a 2 or a 3 or a 4 in a wave or a 5 until you meet these criteria. And those criteria are based on some Fibonacci stuff that he developed, okay? And there's also another woman that does Fibonacci. I think her name is Carolyn. Oh man, it starts with a B. Her last name starts with a B. She's like called the Fibonacci queen. Like she's a real boomer too. She totally believes in Fibonacci, but she doesn't do it like DeMark does. If you really want to go down that rabbit hole, you could read her book. Anyway. All right, man. Eric, you still want that rug pull, huh? You still want that rug pull, huh? No. We pumping, baby. We pumping. We pumping, man. That's why I told you to get the leverage Micron. If you want to be a gambler, I told you what the target was last week. I said Micron's going to go up to $1,000 if we pump this week. We're pumping this week, man. We're going to get to $1,000 a share on Micron. And then you can short it. Once it gets to 1,000, you can short it. And then we go down, and then we repeat, we go back up again to an even higher price. Like Trump's going to keep doing this until we go up to like $8,000 a share on the S&P 500, dude. That's basically it. And you know, like you want to think of it this way, like the way you call it like the Lucy and the football thing. You know, this is a great way of pumping the market. Like I told you, the way with the tariffs, like last year, like you create a negative narrative. You get everybody to get bearish. You trap a bunch of people thinking that it's going to be an easy short. You got to short the market. And then you use all that fear, all that like hedging in the options. And then you release the pressure. You know what I mean? So every time you do this, you go higher and higher and higher and higher and higher and higher on no real news, right? Nothing's changed. Nothing's really changed from the time Trump got elected until now. We were always going to go to war with China eventually. We were all going to do this. All the long-term stuff is still going to happen. But by doing these narratives in the news, you get people to short, get overconfident. They squeeze them. You go up. Then the people that were like out of the market, like, you know, Warren Buffett or whatever, you know, anybody that's out of the market, they look at the price. They keep seeing the price going up and up and up. And then all of a sudden they just give up. They're like, what the hell? I wanted to buy the dip. There's no dip. It keeps going up, and they chase it. Right? You trap everyone psychologically in both directions. You get all the bears hyped up, then you get all the bulls hyped up, and you keep doing this action over and over. And that creates these huge moves up and down, but in a structured manner. It's not like at random, right? It's all constructed, dude. He's doing this purposely and deliberately on a schedule, right? He gave the war after NVIDIA did its earnings. Then once NVIDIA did its earnings this time around, this quarter, then you tease people to think like, oh, you're going to go to war again this weekend, aren't you? Wrong. F them over, squeeze it up, and then you get a 20% move on a $1 trillion market cap company. Micron is a $1 trillion market cap company, and it's acting like a meme stock right now. That's easy cash, man. Easy cash. See? That's how you got to do it. So, like I said, everything's about regimes in this world. You know, everything's about regimes. Anyhow, he's going to rug pull Friday. Yeah, maybe. I don't know. Dude, I don't know. I don't have insider knowledge, dude. I just told you the way it's set up based on the chart. Last week's chart was like, you looked at Tuesday and you said, a lot of people, a lot of volume coming in on Tuesday with all that big sphere. And I'm like, yep, it's going to go back up again a lot higher now. We completed the range, and then we popped on Friday. You got people excited at the end of Friday, and you trapped them again over the weekend to push it even higher. It's crazy, crazy work there. But yeah, we got to get to the next level before we see what we got to do. Okay, so I'm going to go over here. Yeah, I wanted to do this on Sunday, but I was like, oh my God, this is a lot of topics. And I also want to go over Warsh, and oh man, it's going to take me a long time to explain all this stuff, but here we go. All right. So way back when, in 2022, all right, a lot of people were talking the same way we talk about now. This was before the AI bubble started. This was just the COVID bubble. We were in the COVID bubble. We have to remember, 2001 going into 2002. 2002, we had a bear market. Interest rates were going high. Jerome Powell was trying to kill the inflation. We had Russia, Ukraine, a lot of bad news. People were like, oh, the economy is going to go into a recession. So this was at the end of that bubble, right? 2021 was like the peak of that bubble around February for the small caps, high-tech small caps. And then so we went into later 2021, and the large caps were taking over. But that was the end of it. Once the large caps gave up, you know, into January of 2022, we started rolling over. And the Ukraine stuff really killed it at the end. The bond market was already screaming, and then the Ukraine stuff really made it scream, right? You know? So like now we have this wall of worry. Everybody's worried about it's a bubble, it's a bubble, it's a bubble. We got to go to recession. Same talk. We got the same talk. The consumer confidence is very low. It's the lowest it's been since 2022. So people are not bullish on the economy. Small businesses, very bearish on the economy. So consumers, small business, unemployment, there's a issue. People are getting laid off left and right. So it's going up again. But you know, what's happening? Stock market doesn't care. Stock market is acting like we're living in the 90s right now. So yeah, there's a lot of talk of bubbles. You know, yes, we have Michael Burry talking again about what the hell, we got to short this thing. It's a bubble. You got Mark Shkreli, short this thing. It's a bubble. So they've been shorting semiconductors for about 2-3 weeks now, right? Still hasn't gone down. What else? What else they got to talk about? Oh man, Korea too. Oh my God, Korea is crazy. Korea is a whole nother can here. I also heard that Israel is going to lower their interest rate, so Israel will lower their interest rate. So Israel's going to pump their shit up too. So we got some pumping over there in Israel. So we might discuss it a little bit, but the main important point was that, like, how do we look at liquidity? So I got this thing here, and I guess I can't edit this chart. I guess not. I don't know how to do this here. I guess I don't have the option to blow this up. Oh boy. This is like an example chart. This is an example chart. This is frozen in time from 2022. This thing doesn't work anymore, okay? And I'll show you why later. Let me see. Nope, I guess I can't. Okay, well, I guess this is as big as I can make the top panel here. Just look at the top panel. Don't look at this bottom stuff here. This is all a bunch of whatever's here. Okay, guys. So this is a fair value band. And back in 2022, there was this guy who said, okay, we have to measure the liquidity that the Fed is injecting into the markets. And you can't use interest rates by itself for that. You need more information, okay? And he developed this little system here, which was pretty good because it was a good way to tell when the bottom of the market was and when to short, when to long, when to short, when to long. This acted pretty good. This acted pretty well from the COVID bubble up until the end of it when we were starting to go down into 2022. But something changed at the end of 2022 going into 2023. Something changed and this stopped working, okay? This system failed. The market just went higher than the bands. They didn't care about staying within this range that was set up. So how do I determine the tops and lows of this area? Okay, so let me go to this. Let me see. Do I have it here? Okay, maybe not here. I got to go to Twitter for this because this was a Twitter thread this guy made. Okay, so let me see. Okay. Okay. All right. So this is Max Anderson. Okay, Max Anderson. You see this? Fair value for SPX based on net liquidity remains at 3,750. So this was the S&P at 3,750. Okay. All right. So no obvious moves here, intermediate term. However, QRA announcement from Treasury this week materially lowers end of year target from 3,500 to 3,400. And this was in 2022. Okay. So he did all this work here to develop this system. Okay. And let's see if I can zoom in this thing. So you see this green area here? This or green equation here. He puts net liquidity equals Fed balance sheet minus TGA plus RRP. Okay, what is that crap? Okay, so it has nothing to do with interest rates right now. We're just looking at the Federal Reserve balance sheet minus TGA and RRP. What are those? Okay, so if you go to the Federal Reserve website, Fred, FRED.stlouisfed.org, you can get all this data, okay? And you can actually directly connect it to TradingView, all right? So that's how you develop this script. You can look at the source code of this script and you can figure this out. And you can develop this yourself pretty easily. So you can go to any other place and you can just extract the data and put in your Excel, okay? So you could just probably write some Python script or something and plot it yourself, whatever you want to do. But yeah, you could just use TradingView if you have TradingView. It's pretty easy. So you have total assets. All right. So this is the total assets here. So I think this is the Fed balance sheet. This is the Fed balance sheet. So you can see like a great financial crisis, the balance sheet goes up. This was QE. This is the start of QE. Before QE, the Fed never did this stuff really. All right. And then once we had QE, we started doing this game where we started buying bonds. We started actively buying bonds, buying bonds, buying bonds. You can see in 2018, we stopped doing that. Okay. Janet Yellen tried to stop, or I mean, Jerome Powell, I think, was over here, right? Trump already got rid of Yellen by this time. Okay, 2018, yeah. So 2 years Yellen was in charge for Trump. So Trump got elected. She was still around for 2 years. Her term ended, and then Trump put in Jerome Powell. So Jerome Powell started being the Fed around 2018, I guess. So that must be Jerome Powell doing here. So he started reducing the balance sheet. All right. And then something happened. You see, something happened. He stopped it. Now, at the same time in 2018, while he was reducing the balance sheet, he was selling the bonds that the the Federal Reserve was holding. You have to remember, okay, there's two pieces of the government here. Federal Reserve is not 100% government, right? It's partially a private entity. It's a bank, okay? The government can't tell Federal Reserve what to do directly. They can only appoint people in the Federal Reserve, and then they do it. They do the job. That's why the only thing Trump can do really is wait for people to get their terms expire, and then he replaces them, right? That's what he did with Powell. Now, during this time, not only was the balance sheet being reduced, he was raising interest rates at the same time. Something broke at the end of 2018. Okay, that caused the junk bond market, the corporate bond market to crap out, and they stopped raising interest rates in 2019, early 2019. When the market figured out that the interest rates weren't going to go up anymore, they started getting happy. In January of 2019, the market started going back up because it predicted that, I think Jerome Powell is going to chicken out and stop raising interest rates. They were correct. So the stock market recovered a little bit in early of 2019. But then if you look at 2019, it goes up and down like a zigzag, a real yo-yo, because they were kind of trying to guess what Jerome Powell was going to do and what Trump was going to do. Remember, Trump was also doing tariffs at the same time. Trump was doing tariffs or threatening tariffs, doing tariffs or threatening tariffs. And Jerome Powell was raising interest rates and maybe not raising interest rates. At the same time, he was reducing the balance sheet, trying to get rid of QE, trying to give back all the bonds that the Federal Reserve bought from 2008 all the way into 2016. They were trying to get rid of this stuff because if they kept holding these bonds, it would just affect the markets. You know, it would be like, man, they're putting their thumb on the scale, right? By having all these bonds, it helps the bond market stay happy. Okay. So it didn't matter if Saudi Arabia, China, or whoever was selling bonds. They were getting rid of their bonds, right? Japan too, probably. A lot of countries were. And this was not good if they were starting to roll it off and causing liquidity issues. So this was cause liquidity issues as we go along in 2019. So in August, they stopped. And the Federal Reserve was stuck. They were stuck. They were like, what the heck do we do now? We can't go any lower because the stock market, the bond market would go crazy. They would start selling off and people would start losing their money, the 401ks. You have to remember, these people are trapped. Everybody is in the stock market right now. When my parents were around, not many people were in the stock market. All right. People would look at the stock market like it's a place for gamblers. They looked at the stock market mostly like crypto, like how people look at crypto today. They didn't look at the stock market as something secure, a safe place to hold your money. Most people would buy bonds. Bonds were the place to be, not the stock market. Stock market is for degenerates. Well, in 2008 and forward, a lot of people now are in 401ks, right? Not very few, if any, companies will give you a pension. Even the government right now is thinking of getting rid of having pensions that are not tied to the stock market. Like CalPERS, one of the largest pensions in the United States, is driven by the stock market. So they actually have a leadership who came from Wall Street to manage portfolios. So if you work as a cop in California, your money is tied into the stock market anyway. So you don't have a 401k technically, but they do influence the stock market because the way they make money is not through direct contributions, not through just because like someone pays in and then they buy a bond and the bond goes up. No, and pays interest. No, what they do is they buy stocks just like a 401k. So everybody's in the stock market pretty much right now. They're all in. And so it's very important to make sure the US stock market does not crash. So you see here, they gave up, and you go into 2020, and guess what? Boom, we got QE again. COVID lockdowns. COVID was a really good excuse to start QE again, because I bet you they knew that they were stuck. They couldn't do anything. So if you look at it from the demand side economics says that you want to have government spending to drive the economy. All right. Now that kind of limits you in what you can do, because now the Federal Reserve is in the business of driving demand by keeping the bond market artificially happy. If they let the bond market be free, they let the bond market actually be a free market, they wouldn't like the results. The bond market would probably go wild and crash. Like, and then it'll drive the stock market into oblivion if they let it out of control like that. So what they did, I guess, is they purposely locked down the country, and they affected the supply side, because when you lock down the country, you influence how the supply side works, right? You purposely make sure that people can't get out of their houses. They can only buy stuff from Amazon. And then all the shipping, comes directly from China going into America. It gets slowed down. Transportation gets slowed down because of all the you have to be 6 feet away from each other and all this crap. And so they purposely did that, and they gave him an excuse to inject into the bond market again too at the same time. So they created inflation. So they re-injected inflation, because during this whole time before that, inflation was very low, very low. Full employment was very high. People were happy. They had employment again from 2008. I mean, it wasn't complete. We never got back to where it was before 2008, but things were recovering. And all of a sudden, you just crash everything again. You just shake the board again, make people stay at home, and do all this nonsense, artificially create a demand for goods, and kill the service economy, because people can't go outside. So the service economy gets wiped out. And so it's bizarre, right? You do all this weird stuff. You create inflation. And if you look at Japan, that's what happened during the 90s, right? They had inflation that became deflation, and the economy in Japan, not the 90s, I guess. 90s were okay, maybe. I don't know. Maybe late 90s into the early aughts. Japan was in deflationary mode. Their economy was so bad. They didn't have any kind of demand from anybody. So their consumer was very weak. They had nobody in the consumer sector getting anything. People in Japan don't have sex, don't go out, whatever. I don't know what's going on over there. Well, actually, they do go out, but I mean, I just don't know what's going on over there. But their economy was really weak. So we had that. We got that bubble, right? We got that bubble going up here. See, so we buy a lot of bonds. All right. And in mid 2022, we stopped. We started going down. And at the same time, we were raising interest rates at the beginning of 2022 at a fast rate. So at the same time, we were raising interest rates, reducing the balance sheet, and all we got was down here. All we got was right back to where we started at the start of COVID lockdowns. We didn't get far. And now we're going back up again. So the Fed has given up again. It seems to me that the only thing the Fed can do right now is just keep pumping this bubble and keep kicking the can, right? That's the way you want to say it. They're kicking the can down the line. So they don't want to crash the market, but they know it's going to crash, like in a bad way, sometime down in the future. But they don't want it to happen during their administration, their term, their whatever. So they're going to keep kicking the can. Now, if they think that AI is going to solve all these problems for them, I don't know. Maybe that's what they think. Maybe that's a game. They were trying to kick the can as long as they could until AI would start eliminating the problem for them. They would eliminate the need for a labor market, essentially. They would put everybody on UBI, Universal Basic Income. And then from there on, you'll have a permanent underclass of people. A permanent underclass of people that are useless to the technocrat elite. You have robots replacing everything, I guess. And so then you have like an economy where it's just like leftover blue collar work, which can't be automated right now. And a few of the best tech people, okay? I'm not talking about H-1B coders that can just copy paste code. Those guys are gone. Coders that come out of university thinking they can beat the top level coders in Google, they're not going to get a job. They're probably never going to get a job. They're going to be baristas, and even baristas right now are being replaced. So yeah, you're not going to get that. So you're definitely going to need UBI. There's going to be a huge mass of people that have no way of getting a job in the future. That's definitely for sure. Okay. So yeah, that's doomer talk for you. But anyway, so this is the balance sheet. All right. So remember that, because that's the first part of the equation. Fed balance sheet. All right. Now we get on to the second part of the equation. What is TGA? TGA is Treasury General Account. This is the Treasury, what they have in terms of liabilities and capital. So I'm not going to get into this. But this also is very weird, right? You see, before 2008, this was very small. And then since 2008, it started getting bigger and bigger and bigger. And then all of a sudden, in COVID, it's like, what the hell is this, man? So yeah, I don't know what this is, but if this thing goes higher and higher, we're going to have a problem. So let's look back at the equation. Liquidity is the Fed balance sheet, the QE, minus the TGA. So if you have a big TGA, it's not going to be good. Okay, that's not going to be good for you. So you want this number to be small, all right? You want this number to be small. It's climbing back up. Not a good thing. Not a good thing. So you want a Fed that can cancel out this problem for you. You get what I mean? So I think the Treasury Department has a problem, and they're trying to. And Donald Trump hired the new Fed chief to basically be accommodative and try to mask and cover over this leak here. This is a leak. Let's say this is a leak. All right. And the only thing you got is duct tape right now. So you're going to wrap a lot of duct tape around the pipe because we're leaking here. All right. So we need to have this thing go back up again to cover up the problem over here. All right. Let's see. What's the next one? The next part of the equation. Reverse repo. Reverse repo is over here. Okay. You can go to the New York Fed and find this information. Reverse repo operations. You can Google that. And as you can see, this one is also interesting, right? We have these reverse repos, and then all of a sudden in 2021, it was like we just went crazy high here. Every banker started dumping their stuff back into the Fed. All right, so who's part of the reverse repo plan? I'm not going to discuss what reverse repo is. That's going to take a whole 2 hours to explain even this crap. Oh man, but just say that this thing going up is not good. You don't want it to go up. So when we went to 2023, just around the time that the market stopped going down, because you have to remember, stock market was going down into late 2022. And then when we got into 2023, it started going up again. Guess what? We went all the banks that kept their money in bonds in the Federal Reserve, they cashed out of bonds and started buying the stock market like crazy. And so that's why the market went up. Okay, so we basically had this reverse repo start going down a lot. So like JP Morgan, Goldman Sachs, Bank of America, Citibank, all these guys, they started cashing out their bonds that was stuck in the Federal Reserve because the Federal Reserve gave them like really good interest rates, so they kept it there. And then all of a sudden they were like, well, I think stocks are a better play now than bonds, so I'm cashing out. So they all cashed out and they started buying up everything. At the same time, they were going on CNBC telling everybody that a recession was coming around. If there was a recession, why were they doing this? Why were they cashing out all their bonds and starting buying up stocks out here? Tell me that. So they tell you one thing, but they were doing another thing. See? So that's why I told you, don't listen to the news. Don't listen to all these guys. So this is very important to understand this stuff. And that's why you see like this doesn't work anymore. There's something missing. There's something missing in the equation, because this doesn't explain why the stock market went so high like it did during the first introduction of ChatGPT. Once the first introduction of ChatGPT happened, everything just went crazy high. Even at the same time, they were saying recession. So something else is going on, and this equation is not perfectly explaining this. All right, and I'm guessing it has to do with the private credit market. It has to do with like Nvidia going out of its way buying shares of other companies. Yes, Nvidia is going out there and buying shares of other companies. Nvidia has so much money that it's actually using that money to buy other companies' shares. So there's actually money being injected through other means that is not captured here. All right. So there's private credit. There's Nvidia buying shares. There's all the bond markets from Oracle, Google, Microsoft, Facebook, all these guys using it to buy all this equipment to build data centers. That's not being captured here. I think all this stuff, the reason why the stock market is going up so high is because like you don't put this into the equation. That itself is also liquidity, right? AI right now, the hype of AI is also a form of QE, a form of credit, but in the corporate side, because this equation only takes care of the government side, right? The government and like the partial public sector of the Fed. But it doesn't cover the private sector. We don't see what the private sector is doing. What are the shareholders buying SpaceX stock right now? SpaceX stock is a private stock. You don't see it. It's not on the stock market yet, right? If I looked at the price gains of SpaceX, it's probably so huge that you might as well add that to the equation here. So that affects everything, right? Because that itself also affects the bond market and indirectly affects the public stock market that you see on the outside. So anyhow, yeah, so let's look here. Anything I want to look? No. But anyway, this is the basic equation. Fair value equals the Fed balance sheet, this chart here, minus TGA, this chart here, minus RRP, this chart here, divided by 1.1 minus 1625, blah, 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 whatever. And if you want to figure out why he did all that, how he did all that, you have to go to Max Anderson. Okay, go to his handle, and you can go to Twitter and search for liquidity, and you'll find it. You'll find all this stuff that he wrote here. All right, for you. Okay, that's enough. That's enough now. So I didn't completely talk about the Federal Reserve, but I think this gives you an idea of how complex the system really is. You can't just look at, oh, interest rates go up, that means stock market should go down. No, it's not that simple. If it was that simple, everybody would make millions and billions of dollars on just looking at stock charts or trading view and just be like, yeah, I know how the market works. Once you know how the market works, they flip the script and change the game on you. Okay? The game is always changing. It's a dynamic system. So first we had the COVID bubble, which was driven by the Federal Reserve. Now we have the AI bubble driven by Microsoft, Nvidia, Google, Facebook, right? Amazon, all these guys doing stuff in the private sector, injecting, money into building data centers, which is like a form of spending, right? A form of spending. Even though you can't say it's part of the government, it might as well be part of the government. And if you're a conspiracy theorist, you probably already believe it's part of the government. All the big tech companies are basically subsidiaries of the CIA, NSA, right? Deep state, whatever. So it might as well be considered government spending. There you are. Yeah, the rumblings of the private sector being in trouble. Yeah, that's probably where the bubble is going to pop. But it's probably not going to happen anytime soon. Okay, hopefully. I'm not guaranteeing that. Yeah, I'm not guaranteeing that. But yeah, it'll pop. But we won't see it, right? It's all in the private sector. We don't have access to the data over there. If we had access to the data over there, I could redraw this with new information, and then we could tell when the stock market is going to crash. But I don't have that information for you. Yeah, sorry. Yes, I would assume they know exactly where they want the can to go. Yes, exactly. I think they do know exactly where it is. Yes, they know. They know everything. Everything is predicted. Israel's gonna make iPhone chips. Israel's market's already been pumped, so they're probably gonna try to catch up to the Koreans now. Yeah, Israeli AI drones. Yep, that's gonna come out. LUNR in the interact. What is that called? Whatever. I forgot the real name of the company. I just call it Lunar. Yeah. All the space stocks went up again. All the bubbles are going up again. Yeah, so I don't know, and then it crashed. Yeah, I don't know. Don't be messing with the stuff unless you're willing to trade. Everything now is trade. Everything you see up until June, when we have SpaceX IPO and Kevin Walsh, is a practice run. This should be your practice run. You should practice how a bubble market behaves this next few weeks. Okay, so it gives you a little teaser of what you'll see next year if we continue on, because next year will be an even bigger bubble, a more massive one, where all the stocks will participate. Yeah, it will be wild. It will be wild. Guaranteed. Okay, we're done with that. Let's go to history now. Let's go to a little history. Let's see. 39 minutes. All right, let's wrap this up. All right, let's talk about the history of the chair of the Fed. Okay, this is your new guy here, Kevin Walsh. But let's look back in time. There were two Federal Reserve chairs that lasted about 18 years. All right. This is the first one, William McChesney Martin. His terms in office was 1951 to 1970. So he presided over the largest expansion we had. All right. So this was when America became the superpower that it is. So after World War II, America was fighting the Cold War battle with the Soviet Union. And this is where you get this huge economic expansion, all right, during that time. And he presided over that. So we had good times up to the 70s, up to like the early 70s, right? So that's about it. And this is when the Vietnam War and all the Arab countries versus Israel started causing problems, right? At the end of the 60s to the early 70s. So he presided over most of the great expansion at that point. Then we had to switch over to a new Fed, all right? And then we got Arthur Burns, and then Arthur Burns got kicked out by Jimmy Carter, right? Jimmy Carter, I think that's right. So let me go to this one here. Let's see, Jimmy Carter, blah blah blah. Okay, let's see. All right, so Arthur Burns. All right, so this article is from the William Miller article, but it summarizes everything you had here. When President Jimmy Carter took office, Nixon appointee Arthur Burns was the chairman of the Federal Reserve. President Carter recognized Burns' understanding of the business community, but Burns openly criticized the administration. Sounds familiar? Sounds like Trump versus Jerome Powell. Acted against White House objectives and contrary to the administration's goals. prioritize fighting the era's accelerating inflation over unemployment. Sounds familiar, right? Consequently, the president asked Vice President Walter Mondale to create a list of candidates to replace Burns when his term as chairman expired. All right. So all this should sound familiar to you. So history doesn't exactly repeat, but it does rhyme. So Arthur Burns, 7 years as Fed chair, you might as well think of him like Jerome Powell today. All right. So we kicked this guy out. All right. So Jerome Powell is out. We replaced him with William Miller, but he wasn't really doing anything. He only lasted about 1 year before he became head, 1.5 years before he became head of the Treasury Department. So he got pushed out. And then we had Paul Volcker. Paul Volcker, very famous for jacking up the interest rates. Okay. So because Jimmy Carter basically said inflation doesn't matter. Okay, forget about inflation, fighting inflation. We got to increase demand, and we'll try to get out of our problem, our stagflation problems, another way, which was false. You cannot fight stagflation without, causing a lot of pain. The only way to fight stagflation, as far as we know, is to raise interest rates a lot. So a lot of people criticize Jerome Powell for not raising interest rates enough. Donald Trump criticizes Jerome Powell for not stopping raising interest rates and actually reducing the interest rates. Okay? Donald Trump has a different idea of where things should go, and he got another guy for the job. So we're going to skip Paul Volcker because Paul Volcker essentially was the guy that had to start what Arthur Burns started, but even become more aggressive, okay? There was an 18-year guy after him. It was Alan Greenspan. Alan Greenspan presided over the second largest expansion of the economy during the dot-com boom, the tech boom, the PC revolution, the personal computing revolution, and then the early internet revolution, okay? So he was in charge of that. Alan Greenspan believed that technology, would get us out of a lot of problems. So he encouraged a lot of growth. He liked growth. He was like, oh, computers, great. They're great. Grow them. Those industries are going to be awesome. So he was always encouraging tech expansionism. Okay. My guess is that Alan Greenspan is today's Kevin Warsh. Kevin Warsh is going to act like Alan Greenspan until something breaks, and then we have to get a Paul Volcker. So we're going to have an Alan Greenspan this time before we have a Paul Volcker. That's what's going to happen. That's my prediction. So you can clip this out. I'm going to say we're going to have an Alan Greenspan type Fed, and he's going to run the show before we run into big problems, and then we get a Paul Volcker coming in and slamming the brakes really hard. Okay, because something will break. Something will break later on because of this crazy nonsense. All right. So that's a short history there. I think you can learn more about these people, on Wikipedia pretty well. You can learn about McChesney and all these people. These people are all insiders. McChesney is he has huge connections to Woodrow Wilson and all these people that created the Fed, and I'm sure there's books, right, about it. A lot of conspiracy books too, I'm sure. I haven't read any of the conspiracy books, but I'm sure they're gonna tie this into somehow with the Rothschilds or some crap. Whatever. All right. Okay. So that's enough of that. Done. Okay. Finished. 46 minutes. Yeah, Warsh is akin to Greenspan. Yeah, and you'll see why, because I have an article from somebody that agrees with me. Somebody just recently wrote this article. I found it on Twitter, and I was like, yes, somebody here is actually smart enough to realize this. And it's on Yahoo Finance of all places. So let me read that for you guys. Okay, here we go. Yahoo Finance, the best place to know financial news, right? So this was written on Sunday. Perfect timing. When I was talking about we should talk about the Fed. All right, new Fed chair Kevin Warsh suggests he may take an Alan Greenspan style approach at the central bank. So Kevin Warsh is officially our head of the Federal Reserve since Friday. So he offered some telling comments Friday about how he may govern as head of the U.S. Central Bank. Warsh harkened back to former Fed Chair Alan Greenspan, the last chair to be sworn in at the White House, and implied that he is setting himself up in a Greenspan's mold. I've known 5 of my predecessors in this job, some of them quite well. But Chairman Greenspan was the first to tell me and show me what this role demands, Warsh said during a ceremony in the East Room. Like Alan, I intend to fill the role of chairman with energy and purpose, just the way Chairman Greenspan did. Greenspan is known for holding rates steady rather than raising them during the internet boom of the 1990s, and that caused the real estate bubble in the zeros, the aughts. So having this guy pump up the stock market was the reason we had a huge crash in 2007, 2008 later on. So maybe if we're lucky, we can have this bubble last 2 years, maybe 3 at best years, huh? That would be great. I would love to turn my millions into billions, okay? Because you need a market like that to make a lot of money, all right? So if we're going to pump this bubble, let's do it right. So Greenspan is known for holding rates steady rather than raising them during the internet booms of the 1990s because he saw that inflation was not rising and thus productivity must be increasing, negating the need to raise rates. Treasury Secretary Scott Bessent, who favored Warsh to be Fed chair, frequently cites Greenspan as a historical model for managing the U.S. economy. So we got 2 guys that like it. So Scott Bessent likes it. I'm sure Trump likes it. All right, there we go. Frequently cites Greenspan as a historical model for managing the U.S. economy. Bessent favors Greenspan's approach of resisting premature interest rate hikes during technological booms, advocating that the Fed keep monetary policy flexible to encourage growth. They're not going to care about interest rates, man. They're not going to care, man. They're not going to care about any of the inflation. You guys are going to have to suffer with like $10 a pound ground beef or whatever. I don't know. How much is it? 22, 30? Fuck, who knows? Everything's going up, baby. Everything's going up. I gotta check out like what all the expensive stores like sell this crap at. I mean, I'm sure like unless you have a Costco card, I don't think you care. But even Costco can't hold everything down forever. All right. Bessent argues that Fed officials should maintain an open mind and lower interest rates to spur investment. He often calls for the central bank to emulate Greenspan's resistance to premature rate hikes to foster non-inflationary growth. The Fed needs to have merely an open mind. The open-minded maestro, former Fed chairman Alan Greenspan, resisted premature rate hikes during the technology boom of the 1990s, and history proved him right, Bessent said in a speech on January 8th. Warsh said last year that he believed adoption of artificial intelligence would boost productivity, lower inflation, and create a path for the Fed to cut rates. They're going to believe that AI is going to solve all their problems, like I said. Yep, here we go, baby. Yep, here we go. This is it. We're going to have a bubble, guys. He also said during his confirmation hearing that he believes members of the Fed should speak less frequently, pull back forward guidance, and stop telegraphing what the central bank will do before interest rate meetings. So he might just stop showing up to these pressers. So he won't even let the press know what he's doing. He wants to go back to the old times. The old times, the Federal Reserve, never said anything. All right, they never had to go in front of the press. They did what they did behind the curtain. If you guys remember what I said on John Galt's stream, about Wizard of Oz. Wizard of Oz was actually a criticism of the Federal Reserve or central banks in general. I don't know if they had a Federal Reserve at the time book was written, but people have always talked about having a central bank in the United States since the beginning, right? Alexander Hamilton, all these people were arguing about, let's have a central bank. Let's have a central bank. If you remember, Andrew Jackson was the one that broke the central bank. They made a central bank, and then Andrew Jackson dismantled it. All right, they put him in the $20 bill anyway, though. But yeah, there's always been this debate about central banks in the United States. And if you looked at the story of the Wizard of Oz, you have the yellow brick road, which was a metaphor for gold. In the book, it was silver slippers, not ruby slippers. Okay, so it was a metaphor for silver. And the wizard was basically the central bank. All right, behind the curtain. Okay, the emerald was the greenback representing the U.S. dollar. So yes, so that's what all that stuff meant. So you could probably read another book on that where they explain all the allegories about the whole thing. But yes, that's what it is. Okay, that's what it is. So right now, Warsh wants to go back to the times when they didn't even need to talk to the public. So they'll surprise you. This time, they'll want to surprise you with what they do. They don't want to tell you what they're going to do ahead of time. They're going to surprise you, all right? If that's what he's going to do, it's going to be a very interesting stock market. That's for damn sure. The stock market is going to be really in the dark, all right? The bond market is in the dark. Nobody knows what they're going to do before they do it. Amazing. So, and he did not commit to holding a press conference after every policy meeting, a practice put in place by current chair Jerome Powell that is closely watched by investors. All are practices that resemble the Greenspan era. So we're going back to Greenspan. Yes. Oh, who was the witch? I don't know who the witch was. You guys can figure that out. I have no idea who the witch was, man. But yeah, you can reread it or rewatch the movie, and then you can figure out, whoa, what does this mean? I didn't know that the Wizard of Oz was about gold and silver bimetallism. Yeah, look it up. Look up in your Google, gold, silver bimetallism or something like that. There you go. You'll figure it out. So this was always a big deal in America. America was always having fights about these issues, about the dollars, the gold, the silver, everything, you know. So America is such a crazy experiment, I swear. Anyhow, all right, done with that. Okay, good. Let's see what else we got here. We got some other news. Let's move to China. I want to talk about China a little bit here. All right, let's do some China stuff. Okay. So China, this was Friday. China launches major crackdown on cross-border stock trading. Okay, so this was Friday, May 22nd. China has launched an unprecedented campaign against illegal cross-border trading to stem capital outflows, threatening severe penalties against popular brokers and ordering non-compliant accountants to be liquidated within 2 years. The pushback came in a quick burst after the onshore markets closed Friday, when 8 regulators issued a joint statement vowing a campaign against these trades, sending U.S.-listed Chinese stocks tumbling. The securities regulator said it planned to penalize brokerages Futu Holdings Limited, Tiger Brokers, and Longbridge Securities Limited for operating on the mainland without a license, and would confiscate all illegal gains from their domestic and overseas entities. So I'm guessing they didn't like that all these Chinese were gambling on Korean stocks, so that's probably why or US stocks, so that's probably why they shut it down. because there were so people inside China were using Hong Kong brokerages to buy stocks in other places. And when everybody is seeing Korea go up and the United States go up, and the Chinese are like, dude, Chinese stocks are so bad. Why don't I just put money and buy some Micron and SK Hynix? Sorry, you gotta shut it down. So no more money for you. Hong Kong's market regulator also announced measures on accounts for mainland Chinese investors. Futu later said regulators proposed about $271 million in fines, while Tiger Brokers owner Up Fintech Holding Limited said it was subject to a combined 411 million won, $60 million in fines and confiscated income. The impact on the broker's shares was swift. Up Fintech saw its American depository receipts, ADS shares basically, sink 25% on Friday. Yep, I saw that dip. I was pretty tempted to buy it, while the U.S. listed shares of Futu tumbled 27%. The decline spread to other Chinese stocks, as the Nasdaq Golden Dragon China Index fell 1.9%. The moves amount to China's most aggressive attempt to yet clamp down on its citizens finding ways to trade overseas markets, a long-running practice that is officially off limits for a nation that imposes strict capital controls to defend its currency. Same thing with the Bitcoin, right? Crypto. So same thing. They did the same thing over there before. They let people gamble for a little bit and then shut it down. But the ramifications may be much wider than just the brokers targeted. Chinese companies' global ambitions have led them to list in New York, London, and particularly Hong Kong. And Chinese citizens have invested large sums as they follow their national champions overseas. This came as a huge shock. So basically what they're saying is that these guys would rather buy Chinese stocks that get listed on the NASDAQ or the New York Stock Exchange. So that's another reason why they started clamping down, and the U.S. started clamping down too. Because, yeah, the U.S. can indirectly mess with people in China through the stock market. So the Chinese know this. And when Trump started doing tariffs, the Chinese said, like, nope, time to stop allowing Chinese companies to put their shares in the U.S. stock market, because then it would give the U.S. too much control over them. And as you know, Russia got a taste of that, right? Russia went to war with Ukraine, and immediately the United States started attacking them financially through the markets. So they cut them off from the SWIFT system, so they got de-dollarized. They told everyone that any share that was listed on the EU markets, so any share of Gazprom, any Russian company like that listed in Germany and France and England, the United States, whatever, they all should be shut down. So the Chinese are trying to avoid these issues. They saw what we did to Russia. They see the game plan. They're like, yep, we better stop like letting the United States have too much influence over us. So we're going to do this. This came as a huge shock that the plug would be pulled today. Yeah, they surprised you. So he must have said something, you know, she must have said something to Trump. Trump must have said something to him, and they had to do this. Said Chen Da, founder of Dante Research, adding that the biggest surprise was the push to close existing accounts within 2 years. This is very bad news for Chinese ADRs and the Golden Dragon Index if people rush to liquidate all at once. Up Fintech said in a statement that it would actively cooperate with the relevant process, and all business operations remain normal. Representatives for Longbridge didn't immediately respond to requests for comment. Futu also said it will cooperate with regulators and that business outside mainland China remains normal. China clients represent about 13% of total funded accounts, the firm said in a statement. The penalty on Futu likely refers to revenue from mainland clients before 2022. Morgan Stanley said in a research note, that's because Futu has largely stopped adding new mainland clients since then. So these are basically people that didn't get the hint in 2022 that stuck around, and now they're getting punished for sticking around too long. So, they had a warning during COVID. They should have known, like, it's time that you guys pull out, because China and the US are now not buddy anymore like the 90s, all right? It's not like the 90s. And the requirement that at that time was to ask brokers to continue serving existing clients, according to analyst Chi Yao Huang. Separately, JP Morgan Chase & Co. cut Futu to neutral with a price target of $87. Chasing taxes. The Hong Kong stock market's strong performance has attracted a growing number of mainland investors to open overseas accounts illegally to trade there, increasing outflows and likely providing authorities a stronger incentive to stop such practices, said Alan Wang, a Shanghai-based partner at Qingchen, Dao, Tongda, and Neil law firm. The latest move also coincides with Chinese tax authorities' intensifying drive to get its citizens to pay taxes on offshore income. He noted, a number of clients have since last year been contacted by officials to pay taxes for gains, including those from overseas stocks trading, with some having opened new accounts in Hong Kong after 2022. The joint plan issued on Friday by the Chinese Securities Regulatory Commission, the People's Bank of China, the Ministry of Public Security, and 5 other government bodies aimed to dismantle unauthorized offshore investment services that target mainland investors. Officials said the measures are designed to clean up the capital market and steer investors toward regulated channels for overseas investments. Oh, you mean places where they can track your ass because these guys weren't paying their taxes or some shit, huh? An estimated $1.04 trillion of so-called hot money flowed out of the country in 2025, according to an index compiled by Bloomberg Intelligence, the largest annual outflow since data began in 2006. Under the new initiative, overseas institutions will be banned from marketing in China related to securities, futures, and fund products. They will also be prohibited from offering account opening services, executing trades, or facilitating fund transfers for domestic clients. The crackdown extends beyond foreign firms. Domestic entities that assist such operations, including intermediaries that solicit investors or companies providing website, trading software, or customer support, will also be subject to enforcement action. Oh man, I can't open a trading view in China. I'll get slapped too with this. Oh, internet platforms and social media accounts publishing illegal promotional content are included. You mean I can't go to TikTok and try to pump up my random shit coins? Bruh, this sucks. Isn't Weibo from Hong Kong? Yeah, Weibo, yeah, or something like that. I don't know. Weibo is Chinese. I know that. I don't know if it's from Hong Kong though. But anyhow, yeah. Okay, that's enough. That's enough. I don't need to read anymore. Okay, what's the next news? What's the next news here? Blah blah blah. We covered that. Covered that. All right. Okay, we got 1 hour. Right? Perfect. 1 hour. Okay, let me take a break. Let's watch a video. So this video is an update for the options. So maybe this will explain things to you guys. All right, here we go. Okay.
Market is anything but normal right now. It's after Memorial Day, summer's coming up, and people usually expect quiet markets during this period. But this market and this summer, you should expect anything but. In this video, I'll show you exactly why. 2 weeks ago, we spotted a top in May. We topped around 7,500 with May's expiration, but it was only worth about a 2.5% pullback. In the last video, we talked about how the market's kind of caught in the spot up, vol up feedback loop, where both the index level and the volatility levels in the options correlate positively. Totally different than normal. That creates problems. One of those problems is coming up now into frame as we come closer and closer to the positioning that creates that very impact. Now, if you missed that video, here's Matt to explain again what spot up, vol up means.
So normally with the S&P and vol, there's an inverse correlation. When the market rises, the implied volatility of the S&P options usually goes down, and vice versa. When the market sells off, the implied volatility of the S&P options usually goes up. Normally on the upside, there's a lot of call overwriting and yield harvesting. Basically people selling options to overwrite their longs or to harvest yield to get some premium. On the downside, there's usually hedging. People are hedging their positions by buying puts. But what we've seen recently is that there's been a chase for the upside. Very unusual. We're seeing people maybe replace their long equities with long calls, are people who are underallocated, have just been buying calls. But this has caused the position to completely flip, whereby we rally, and instead of vol coming in, market makers are getting shorter vol. So they are raising volatility as we rally. This is the most persistent spot up, vol up that we've seen since January of 2018, right before Volmageddon.
What Matt talked about was this idea of a normal regime versus an abnormal regime. What you're going to see often is this gamma curve, or the GEX profile. Now, what this is the market maker's aggregate gamma exposure by spot level. It changes every day. Behind this graph are positions expiring today, tomorrow, 1 month from now, 6 months from now, etc. But obviously, options that are expiring nearer term have more gamma, so contribute more heavily to this. In a normal market, a lot of positioning exists 30 days out. And that positioning is like Matt described. People hedging their equities with puts, buying puts, creating short gamma for the market maker if the market sells off, and people financing that by selling calls, creating long gamma when the market rallies. Now, this creates what we're used to, which is shallow dips that are erratic but bounce quickly, that come with vol spikes. And when the vol relaxes, the market shoots back up. And then as we rally, the market's...
All right. Okay, you guys don't know what Volmageddon means? Man, dude, there's a lot of stuff you guys need to know about. Holy shit. Oh, man. So he said that was like in 2019. Remember what I was talking about at the beginning of the stream, right? I was talking about weird stuff was happening in 2019. Late 2018 to 2019. Okay? Yeah, there was junk bonds. There was Volmageddon. There was some crazy stuff happening, man. So get ready. It's going to be fun. It's going to be real fun. So if you pull up a chart on 2019 and tell me what that looks like. So late 2018, going to 2019, and then we had COVID. Look at that chart. Tell me, like, what the heck was happening there? It was the most volatile time ever. You know, and I told you guys I retired in 2018 to 2019. So from 2018 to 2019, I was retiring. I was basically saying, like, dude, this Trump market is crazy. I could make more money trading than I could go at work right now. And so that's what made me like consider retiring too, because, you know, I was always just a buy and hold guy. I would just invest, don't need to look at it. It'll go up. You know, I just did my little stock picking here and there, but I never really traded. Okay, I would just maybe do a little fun thing, maybe once or twice. In a blue moon, I would do some swing trade, but I would never take trading seriously. But in 2018 to 2019, the market started acting funny, right? And I was like, man, it's acting so funny. Trump is purposely trying to make this thing yo-yo. And all these guys in the Fed and all these, it's like, man, you can make a lot more money trading. Because if the market just goes up 20%, goes down 20% every 3 months, guess what the stocks underneath the surface of the index are doing? There's a lot of stuff you could trade. And then COVID happened and then everybody got happy, right? Everybody went crazy. Everybody started joining the party. But I already started joining the party 2 years ahead. I didn't know that it was just going to get crazier and crazier and crazier all the way up until now. It's been like over 6 years of wild moves, right? Almost a decade now, where we had like such a great market to trade. And that's pretty much convinced me why trading is not a bad idea. Like, if you can predict all this wild, wacky shit in a pretty reasonable way, in a pretty predictable way, you don't need to work anymore. And then now we're going into the point where we could be going into a 1990s, late 1990s type market, all the way into the dot-com bust. It's just like, dude, this is your last chance of making really good money, because the volatility is, yes, you got to make it in both directions. Yes. So it's like, yeah, what can you do? No, it's just, I think, let me see. It has something specifically to do with options. Okay. Volma is a Greek letter to them. Volma is not a real Greek letter, but in the options world, there is a Greek letter called Volma, I think. Let me see if that's true. Maybe not. What the hell is Volma? It sounds like something they would make up. It sounds like a letter they would make up. I'm not either that or it just means a volatility, but I don't know why they would call it Volma. Volma sounds like a made-up Greek letter that they made. Because you have to remember, they have gamma, they have delta, and then they start making up Greek letters. They go into like charm. Charm is not a Greek letter. What is charm? And then they go like oh, dude, you guys are charm and let me see if I can find it. Okay, all the Greek letters here. Volma, and then charm, and then Greeks options. Let's see if I can find it. Yeah, Vomma, Vomma, Vega convexity. So they made up a letter Vega, and then Vega, from Vega they made Voma. From charm is delta delay. I don't know why they had to make up a letter for that. So yeah, so Voma is delta Vega over delta vol. So Voma, Vomma, measures the acceleration of Vega. If volatility goes up, Vega goes up. Voma tells you how fast that increase. See, they're just making up shit. This is crazy. All right. So I thought the Volmageddon was like a play on the Voma thing. Like, so I mean, whatever. So it's volume and Voma at the same time. Whatever. Dude, I don't want to get into this, but yeah, it's something like that. These guys live in another world, man. These guys live in another world. So it's very much like people that are just huge nerds, and that's it. If you don't know the higher level mathematics, it's just like, who cares? Who cares? I don't think you need to know this shit, but but you need to know about this though. You can't, even if you don't play options, you need to know about this stuff. And most people who gamble with options, they don't even care. Like, most of them, they just go like, oh, I just want leverage, so I just buy a call or buy a put, and I just get leverage. No. Real options traders are messing around with 3 orders of derivatives and all this partial differential equations, or who the hell knows what they're using. It's like, what the fuck, dude? You guys are nuts.
Slows down. The price action goes concave. You can see it on the chart. It spikes here, but by the time you get to these spot levels, the price action is flattened. Now, what we have right now is exactly the opposite. And actually, we've already kind of crossed the threshold in a sense. It's almost fair to say the market's more in this range right now than this range. We're losing positive gamma as we go higher because the market.
So essentially, we just changed regimes, right? So that's why I told you guys, like, you can't apply the rules that you learn like in every instance. Okay, the rules keep changing. So the market might work one way at a certain time, but then another times it will work in a different way. And you were like, why does it work in a different way? Well, because the options market, the curvature flipped. So it's like you worked in this regime and now you work in another regime. It's like as if you, first of all, you were like, oh, I'm living in a refrigerator. I'm hunting seals. I'm afraid of polar bears, and and I'm fishing in a lake, okay, with a bamboo stick, like Mr. Deadman. Oh, actually, did you guys know that Deadman caught a fish? Okay, we could play that later if I got time. But anyway, and then all of a sudden, somebody like God started started changing the thermostat, and then it just the radiation from the sun started cranking up like a few rads or something, and then rotogans or whatever, and then all of a sudden like everything heated up, everything melted. Now I live in a jungle. Now tigers are everywhere. Now I gotta worry about monkeys dancing on my head. And yeah, so like this is what happens. This is a dynamic system. You cannot play the game the same every time, at every place, every case, you know, unless you know that something's changing. The best thing you should do here is like recognize, yo, I know there's options out there. I know they have a big influence on the markets. Even if I don't know what's going on, at least I know what days the option market expires, the future markets, futures market for the VIX expires. I should know at least the basics of like where to look. You know what I mean? Like you should at least know certain YouTube channels that talk about it, like this one. You should know maybe some Twitter channel, like people you could follow that talk about it. So even if you don't know, you should know where to look and see if these guys start going like, yo, something's happening here. And you're like, oh, really? Okay. I'll make note of that. And then you just change the way you prepare for the next week, all right, when you trade. So that's why last week I told you we were going to have bumpy ride, right, from Friday on. That's why I played this guy's video that Thursday into Friday and then into early last week. Now I'm playing you this video again because now I showed you like everything's flipped because I played this video on a Friday until now. Now you see things are changing. All right.
It's abnormal. Like Matt described, when we have situations like this, it's common to see people buying calls instead of owning the underlying stock because of the risk to holding equities. Or money managers who are under allocated and haven't participated in this rally, they need the leverage of options to get involved. And so they buy calls instead of buying equities. And importantly, too, in both these cases, you're also not getting the put buying associated with the normal market. So it looks different because it is different. Now, this creates a spot up, vol up dynamic, but the market's kind of delivered us already through this feedback loop to the point of problem. Now, bear with me, because this GEX profile is created by a lot of different options of different maturities. The most important maturity to keep your eye on right now is actually July. If you're looking at positions, it's important to keep in mind the serial positions, the third expiring Friday AM, is always going to be worth tracking. It's where the biggest inventory is built up. It's where VIX benchmarks to, and a lot of OTC products benchmark to as well. And typically, it contributes to the gamma profile kind of like this, where it's call overwrites that create the positive gamma that creates this.
Man, this guy needs to get a new marker, bro. Like you can barely see the line he drew, man.
Positive drift. Right now, however, the market's positioning is very different in the options that we're talking about. Instead of having this nice stable pile of overwrites, the July position is negative across the board. There's virtually no areas where market makers are actually long options. So it's creating a negative gamma bias that persists across this range and gets worse to the upside. So two things are going on here. We still have spot up, vol up behavior, where because we get shorter gamma as we rally, it's a problem. It's inverted correlation. But there's a bigger problem too, because as time passes and the positions that actually give us some positive gamma expire, and the positions that are all short across the board become closer and closer and closer to expiration, more and more gamma in those options, this is going to get dicey really quickly. So most of the time we assume that the market is slow and it's a trough in volatility, but this...
No, there's no real, like, if you listen to Tom Bowley goes on stock charts. Like he has some videos up there. You can also go to earnings beats. So look up Tom Bowley. So Tom Bowley, the way he does it, he essentially says that like if we have a direction, we'll go in the opposite direction for that third week. Okay. So let's say the market is going up into options expiration week. So after the Monday of that week, so during the Monday of that week, when it expires Friday, it will go opposite of it. So if we're going up, it should go sideways to down, right? That's what happened last time. We went kind of like pretty much down, sideways a little bit, mostly sideways. So we stopped going, right? And then once we got through it, we continued on. So if we were going down into that options expiration week, we probably could, go up or sideways before continuing down again. If the trend is very strong, you have to have a strong trend though. All right. We had a very strong trend going up, right? So that definitely mattered. The other thing to know is that the Monday after options expiration week is usually going to be lower than the Friday. Okay, whatever happens on a Friday. So whatever price action you had on a Friday, the Monday after, it should be lower than that of that. So either like you go down in the morning from the close of Friday and then you recover a little bit, or maybe you just stay down until Tuesday, something like that. So usually it tends to have a bad Monday from the whatever happens on a Friday. So after the Friday expiration. So there's some kind of maybe consistency there, some pattern there, but not really. Okay, I wouldn't like put all my bets on it, on that kind of like you can like crystal ball that thing. Okay, I think you're gonna need a lot more options knowledge than that. That's just what the boomers believe in, because that's just kind of like statistical pattern, right? Statistically, that's what you see. So based on statistics, you kind of go like, well, I have a lot of data of a lot of options expirations weeks, Mondays after that week, and I can use that to guess what's the probability that something will act like a certain way, right? But that's not guaranteed. The game is always changing. The game is dynamic. It's not like I play craps in Vegas and I know the odds of me getting a snake eyes or a 7, right? Like those odds are always the same in a casino game. This casino, the game always changes. So you can't trust that. You can't trust, like a lot of boomers, they will do that. They will just like go take Excel. They'll just go like, okay, every Monday after the Friday expiration, how many times did we go up from the Friday close or this and that? What's the probability? Okay, you can do that if you want, but I don't think that's a good way of doing things, because that's not 100% going to guarantee you can predict anything in the future with the way things are now, when the rules keep changing as they are. Okay, yeah. Shake my head. I wish I knew this before buying the dips on that Friday. I mean, that's why I keep warning you guys. you guys need to practice and do this. If you don't have experience, you cannot. This is why you got to do this quickly. So I keep telling people, if you don't start early in your life and play around in the stock market, how do you expect to know this stuff? It's like there's no book that covers every single topic, because the rules keep changing and the knowledge keeps expanding. And if you start too late, you're going to get frustrated too quickly and you're going to give up very quickly too, right? So I'm trying to quickly get you to up to this level of knowledge where at least you can try to practice. So practicing is more important than trying to hoard all. That's what he said, right? Roman from Wyckoff Analytics. Roman, he said, like, don't hoard the knowledge. Everybody keeps trying to hoard knowledge instead of practicing the game. Practicing the game is more important right now. Okay, so yeah, that's it. Man. So yeah, they probably don't. Yeah, I mean that's why we're cheap. We're cheap people. The really rich people are always cheap, man. So that's how it goes. yeah. Buy my product. He's trying to show you that he's rich by doing that. See, he's humble bragging. He's humble bragging. See, I'm so damn rich. I'm just wearing a cheap salmon, freaking salmon shirt that I got from Ross, and I'm using markers that have no ink in them. Yeah. Dead man won. Yeah, dead man won. Yes, the earlier you do this, the better off you be. You don't want the market to be too easy, because then you get overconfident. Like COVID. COVID got a lot of people overly confident. You don't want to be too hard yet. Like the 2022 was very hard. Very hard. So people who started from COVID, they probably lost all their money in 2022 because they thought the market would always act the same way. And then when they went to 2022, they didn't change their strategy, right? And then they lost all their money in 2022. Yeah. So a lot of people, they learned the hard way. But sometimes the hard lessons like that, at least you learn from them. Yeah. How rich people always dress down.
summer might be the exact opposite. Even if the first few weeks of June are stable and complacent, don't fall asleep at the wheel, because as those positions expire, the position coming up behind it is very, very ugly for the market maker. They're short gamma across the board, and there is no relief yet. Now, as this becomes topical, you'll see pictures floating around that look like this coming from banks, like Bank of America and UBS, etc. But we have the exact same positioning data in real time, high resolution, in VS3D. What you can see right now is positions by stripe. This is the hedged position for market makers expiring in the month of June. June 18th, specifically, the AM expiration. Now, what you see on the screen right now is more reflective of a normal position. You can see we're kind of trading at the upper boundary of the range, or the cluster of long options reflected by the blue bars on the right side of your screen. The short options, or the hedges, customer hedges, show up as orange bars on the left side of the screen. Now, when you have a market that's full of orange bars below spot and blue bars around the spot level and just above it, that's fairly normal. That creates the upward drift. The vol spikes when we drop, but it's a hedge market. Often it bounces and we grind back up into the positive gamma range that's created by that long positioning. This is a normal position. Now, I just showed you June's position, and this is July, the next serial after that. The most important expiration after June, arguably July. You can see here it is very different. There is actually no place on the profile where there's just this cluster of long gamma coming from overwrites or sold options. It doesn't exist in July. Instead, what we have is hedging everywhere, not just downside, but even more so to the upside. As the July position becomes the front month position and comes closer and closer to expiration, these options will have more gamma, less vega, will have less to do with vol dynamics and more to do with how the market moves day by day. This is not a stable position. And importantly, it's going to become more and more important, or more of a driver of market behavior just when we're entering the holiday period around July 4th, when most people expect the market to fall asleep, to become very, very vol compressed. The position tells us this time to expect the exact opposite. Now, positions change day by day. Anything can happen. Customers can come back and sell options back to market makers, and the entire thing changes. Now, if you want to stay connected.
All right, that's it. So, I don't know. It's hard for me to understand myself, guys, okay? Very hard for me to understand myself. And, you know, I'm going to have to, I guess I'm going to have to learn more and more about this stuff as we move on, because the market is going to be driven so much by options at a certain point that, like, there's no choice but to learn options into a deeper level to really understand things. Because they're changing the rules again. We're going to have zero DTE, so 0 day to expiration options. They're going to do after market hours 0 DTE, man. And then later on, they're going to be like 24 hours, 24/7 markets. So we're going to have the stock market open like pretty much 24 hours a day. Probably not 24/7. We'll do 24 hours, 5 days a week. But, you know, eventually they want to do 24/7. So the market is like going to be like strictly gambling. Completely out of this world. So these small things will matter more and more and more and more as we move on. Okay, so this question is like, so this tends to cause reversals on all stocks or just major. See, this is another issue here. Like, I'm not sure right now either about this. This question is dependent on so many things. Now you see a lot of ETFs right now. We have a lot of ETFs, right? So if I buy and sell ETFs only, the ETFs themselves have to buy more of the stock, right? That's underlying. So that indirectly affects it. So before, like when we had market index, the market index is based off the price of the stock. But because people buy so many ETFs, they directly influence the index more than the actual stocks underneath. You know, and then we have options and futures. And so all these people playing this game where they have ETFs, have futures, have options, they drive everything underneath the surface. So are the stocks themselves being influenced, or now the index level is influencing the stock level more? I don't know. I think this dynamic is changing all the time, depending on what market we're looking at. As we go. So this is not an easy question to answer. It's not an easy question to answer. I don't think anybody really knows. Loosely causes reversals. Yeah, I guess you could say that. It loosely causes it. Yeah. So Oh my God. Here, let me show you this image that I got today. Look at this thing. Look at this thing from Twitter or Twatter. Let's see. Nope, that's not the right one. I don't want to talk about Korea. Here, hold on. All right, which one? Come on, do I have it? Yeah, this one. Here, this one. Look at this one. More ETFs than publicly listed companies. We now have more ETFs on the stock exchanges than actual stocks. What? So what is driving who? Who is driving whom? What is driving what? Holy shit, man. So if I bought like, Intel, does it matter? Does it really matter? Or is the guy who bought like SOXX, SMH, or futures on the NASDAQ 100, is that more influential to what Intel does than Intel itself? Like Intel has options on it. Intel has Intel shares, also has Intel options, Intel call options, Intel put options. But then you have the S&P, NASDAQ. They also have puts and calls. They also have futures. They also have puts and calls on those futures. They also have a VIX on top of that VIX. Blah, 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 blah. So like, and ETFs everywhere. I have like leverage ETF on Intel. I have ETFs that contain Intel. No. It's not easy. It's not easy at all to say who influences what right now. And that really changes the game. It really does. And the game keeps changing, which makes it fun, right? This is a game that's more fun than anything because it's always, the rules keep moving. The goalposts are always shifting. You don't know what's going on. People's expectations are always shifting. Some people say it's a recession. Some people say it's a AI boom, blah, blah, blah. Just like 2022. Just like 2022, when everybody was saying it was a recession. Everybody was expecting a recession going into 2023, but there was no recession at all. Nope. Everything just bounced all the way back up like crazy. So, yeah. You could spend all your time listening to people on CNBC or on Bloomberg, but they're probably all wrong anyway, most of them. Nonsense. Just noise, just prattle and rambling. Yeah. Okay. Let me see here. Okay, I got this video I just downloaded for you guys. I think this will be more interesting because it kind of explains it in a more layman terms, okay?
We keep seeing doom and gloom videos about the stock market in 2026. We're told the AI bubble is about to burst, that the current market looks exactly like 2000, and we're watching wars and geopolitical tensions unfold across the globe. And certainly, these concerns have shown up in a couple of pretty notable dips this year. But here's what I find interesting. If all these risks are real, and many of them probably are, then why does the market keep showing so much strength?
And right now, the Shiller PE ratio is sitting at 42, a level we haven't seen since the peak of the dot-com bubble.
And I think this question becomes even more interesting when we look at markets through the lens of chaos and complexity theory. On this channel, we've talked before about how markets aren't simple cause and effect machines. Markets can stay much higher than people think they should. Equally, they can crash with surprisingly little warning. What's often more useful than predicting individual events is understanding the environment that the system is operating in, understanding the rules of the game. And I think those rules may have changed. So rather than trying to predict whether the market crashes next month, let's ask a deeper question. Are we even playing the same game investors were playing 30 years ago? The S&P 500 certainly took a big shock this year, at one stage falling nearly 10%. That sounds dramatic, but in the context of historical market corrections, it's really not all that unusual. As Benoit Mandelbrot argued, large market movements are much more common than traditional financial theory tends to assume. And if we zoom out over the last year and a half, this wasn't even the steepest decline in recent times. Really, What we're looking at here is more like a small pimple on a much larger trend. It's certainly nothing like 2008. And if we zoom out even further, say 30 years, using a logarithmic chart, today's movements start to look even less dramatic. Now this is important because on a logarithmic chart, steady percentage growth appears as a straight line. So if markets are compounding steadily over long periods, the chart should look relatively linear. And perhaps surprisingly, the market still appears broadly on track, which creates a strange situation. Despite all the warnings and all the headlines, the market itself doesn't yet look broken. So if everything is supposedly so dangerous, why isn't the market behaving like it? One explanation is that investors believe we're still in the early stages of an AI-driven productivity boom. AI increasingly just isn't being discussed as just another technology. Many people are treating it more like the internet revolution itself, a structural change that could reshape productivity and future earnings. Markets are, after all, forward-looking. They're constantly trying to price in tomorrow rather than today. And at the same time, the broader US economy has held up much better than many people expected. That's partly because the US economy is more insulated from certain global shocks than in previous decades. Take oil, for example. Events in the Strait of Hormuz can clearly affect global energy prices. But the US now produces more oil than it consumes. That doesn't make it immune to disruptions, but it does change the sensitivity of the system. And there's also something psychological happening. Markets often move more on expectations and narratives long before reality catches up.
And the United States is in the midst of the fastest and most dramatic economic turnaround in our country's history.
Confidence itself becomes part of the system. And this is where complexity theory starts becoming useful, because complex systems don't simply respond to events, they respond to the rules. This is where things get interesting, because investors often assume markets behave according to fixed laws, but complexity theory suggests systems evolve. And over the last few decades, investors have become used to a fairly particular environment. Low inflation, steady growth, central banks stepping in during crises, markets gradually drifting upwards with occasional setbacks. Over time, these stop feeling like conditions and start feeling like permanent features. But what if they aren't? What if those were simply the rules of one particular era? Because history shows that when environments change, markets can behave very differently. The Great Depression looked very different. The 1970s looked very different. 2008 looked very different. The point isn't that history repeats. The point is that stability itself depends on certain rules being maintained. So what might be changing? I think there are three interesting possibilities. First, indexed investing. More and more money now flows automatically into broad market indices, regardless of individual company fundamentals. Buying an index increasingly behaves almost like a default store of value. And because pension funds, retirement systems, and passive investment flows keep adding money regularly, the market develops a kind of self-reinforcing behavior. Every payday, more money enters the system. That changes market dynamics. Second, debt and policy pressures. US debt levels continue rising, and eventually high debt places pressure on interest rates and economic growth. There's also increasing pressure surrounding central bank independence. If central banks become less independent, one of the key stabilizing mechanisms in the system becomes less reliable. Third, speculation. AI narratives, cryptocurrencies, and newer forms of investing may be introducing stronger speculative behavior. Crypto especially has already shown extreme boom and bust dynamics. Even if it's still relatively small, it reflects a broader increase in speculative intensity. None of these necessarily break markets, but they remove some of the shock absorbers that used to be there. Now, if we start looking for warning signs, valuations become interesting, because while prices themselves don't necessarily look extreme, valuation tells a slightly different story. Take this Shiller price-earnings ratio. At around 42, we're in territory really only seen around the lead-up to the dot-com bubble. Even compared with events like 1929, today's levels stand out, which raises an uncomfortable question. Are markets genuinely operating under a new structure? I think complexity theory pushes us toward humility here. We simply don't know the answer. Markets could continue doing what they've usually done, long-term growth interrupted by occasional corrections. History suggests that's probably still the most likely outcome.
And I'm not trying to give you any specific advice here.
But we could also see something different. Longer periods of drift, deeper corrections, and more boom and bust behavior. For passive investors, maybe that simply means more of the same. Buy, hold, and keep buying. For active investors, market volatility can create opportunities. But the problem is those opportunities always look easier in hindsight. You never know where the bottom is. You never know how long declines will last, and it could be years. So I think the key point isn't predicting a crash. It's recognizing that markets are complex systems, and complex systems can quietly change their behaviors when the rules underneath begin to shift. And right now, I think it's at least worth asking whether that's what we're starting to see.
All right, guys, that was a very good presentation. Very convenient. I got one article on Warsh, and that one video came out this weekend perfectly. Exactly what I wanted to say in today. So I got lucky. There were two things that were written down for me. This was exactly what I wanted to talk about. Perfect timing. All right, let me wrap up things here, because I was supposed to talk about stocks last week. I had a whole list of stocks, random stocks, and did not mention options as a factor. Therefore, a new factor. Well, yeah, this is a high level video. I don't think he talked about options. No. But I gave you the option stuff, so that's definitely factors right there. Lots of factors. You can dig into yourself. But I think as a philosophical video, that was perfect. That's exactly how you should treat markets. A lot of people, they want to treat markets like it's a deterministic machine, you know? It is a complex system. It is not a linear, time invariant, basic, simple physics problem, okay? This is not that. This is harder than physics. If I get a physicist to do this job, you think I can get them to make money? I don't think so. Hedge funds will hire physicists. They'll hire mathematicians for sure to do this work where they try to model the markets. But the market will always be smarter than they are. Not in terms of oh, it's like a market has intelligence or whatever, but I'm saying that the market will always fool people because it's very complex, you know? If a physicist could tell you everything about the universe, then the physicist would be a god, right? You're not a god. So you have very limited access to information. It's incomplete. You have very little knowledge of the full scope of the dynamics, the interactions that goes between people, markets, what the Fed is going to do, what Congress is going to do, what the president is going to do, okay? And either you believe that it's like a conspiracy where there's a script out there, which could be possible. And I gave you like ideas where you could see there's a script being written. Like there are people being hired at certain times. You had Powell. Powell was like, you could have like a chief, right? You have a war chief, you have a peace chief, right? And then Powell was a chief that was required to go between Yellen and Warsh, right? Yellen was basically like a Ben Bernanke. So Yellen and Ben Bernanke were pretty much the same people. So Yellen was just Ben Bernanke 2.0. So Ben Bernanke and whatever, but they were all after Greenspan. You know, all these guys were after Greenspan. So Ben Bernanke, Yellen, and then we had a temporary interregnum with Jerome Powell. Jerome Powell was kind of like an outsider-ish person, like not outsider-ish meaning like he came from somewhere outside the Fed. He came from the Fed itself, but he wasn't an economist. He was a lawyer who became a banker. The early Federal Reserve were full of people that were lawyers, bankers, and not economists. Only later did we have people that were quote-unquote economists. So he was kind of like a stepping stone person. Yeah. All right. Anyhow, AI trading bots, probably another recent factor that could grow. Okay. Yeah. That's gonna happen for sure. That's gonna definitely happen. All right. So let me get the chart here. All right, guys. All right, let me remove this. Okay. Okay, so so let's look at HUT. Pretty good, right? We're at the top of the range, pretty good right there. So nothing much to say there. NBIS went down, so it's still in the range, not ready yet. APLD, same thing. I think these two guys already had too much of a pump on Thursday, so they're kind of like, people aren't really convinced they can go up any just yet right now. So we might have to complete this range. Core Z, however, looking a lot better. So I might have to move this up. If NBIS and APLD doesn't improve, my Core Z might be number 2 now. So I still haven't decided if I want to leverage these guys up. I need to figure out who's going to be number 2. Who's going to be number 2? Otherwise, I'm just going to keep all these guys as is. I don't want to leverage this stuff up right now. It's too risky. So I don't want to touch that. Okay, let's look at ASTS. Top of the range here. ASTS. Rocket Lab, I think same thing. Top of its range. Yeah, okay. Yeah. Whatever, little range. Very good. I have no idea why this thing went back down, but that was a lot of volume. Okay, not ready yet. Guess not. I don't know if this is a range or not. If this was a range and it broke out, it went back in, that's not a good look. That's not a good look. So maybe there was some news or something. Let's see. Okay, it was some news. Plunged after NASA chose another firm for lunar vehicle and drones roles. Okay, that's why. Intuitive Machine. So sorry, one of these guys can't make it, I guess. Next one up is Planet Labs. Planet Labs was up 9%. This one is kind of like has a nice trend already. So not really much to say about this. It doesn't have a range at all. It already finished this range back in 2025. It's just been in a straight line up. I'm not sure if you want to risk it because we have earnings June 4th, I guess, according to TradingView. Not 100% if that's the confirmed date, but I guess I'll have to double check that next week to see if that's what it is. Okay, let's see what Nokia is doing. Nokia is doing great. We are above that blue line, so we're cool. I think Nokia is going to be a great stock for next year. So if this holds up, let's see what the other semiconductor stock was like. NVTS, right? NVTS, I said, was like great. This one, very nice. The AXTI came back down, so whatever. Guess it didn't have anything to do today. So, but NVTS, yeah, nice bubble stock right there for you to play around with. But let's see what the other end semiconductors. TXN, I said Nokia, TXN, right? Texas Instruments, very good today, 5%. STM, okay, ST Microelectronics, Italian, French Semiconductors company, 5.7%. NXPI, another European company. I don't know. I think this is Dutch or something. NXP Semiconductors, okay? NV, I guess, is Dutch. I think that's a Dutch acronym for a company, all right? Limited liability, whatever. Okay, so that's good. So what about Intel? Intel, kind of boring. I would think like Intel would fly just like Micron would. So I said like you would leverage Micron and Intel because they are the most hated semiconductor stocks. They are the most hated. They are most shorted. People hate them. So if you want to trade Micron right now and Intel, yes, like look at Micron. It jumped right over the range. It just jumped and went to the top of it. That's bad news, bears. You know what? This thing is going to go to $1,000 this week if you can't stop it. If you can't stop this thing tomorrow, this thing is going to 1,000 by Friday before weekly options expiration. You are going to get burnt. Whoever shorted Micron last week, they are going to get killed before this thing comes back down. This was the worst thing you could do. Michael Burry, Martin Shkreli, you're screwed. Time to buy Intel? Yeah, sure. I mean, look, if you're gonna do this, you gotta trade it. Don't think about holding it. You gotta get in, make your money, and get out. This is dangerous. This is hot potato. Hot potato. What hot potato, man? Hot potato. Rocket Lab tried. Yeah, tried. Hut tried too, but it wasn't enough. The reason this thing acted like this is, guess what? I bet you there were a lot of people trying to short this thing last week. That's the only reason it would act like this. They thought it was like, oh, this is a no-brainer. I would short it, and it should go down. Guess what? Whoever was shorting it over here or shorting it down here, they're in major pain right now. They have to pray that this thing is coming back down by Friday. Really pray. Whew. I don't know. Oh, you got some NVTS? All right, you got some NVTS. Good for you. Enjoy the gambling. Curious what you think about band and HYLN. Okay, let's see. I don't know. Let's see what this is. Huh. Holy crap. Yeah. This is a gap and go stock, right? This is basically like CrowdStrike or Palo Alto Networks, you know? Gap on earnings. You know, this wasn't earnings, but it gapped on somebody else's earnings. It gapped on what's it called? Fortinet, right? Palo Alto Networks and CrowdStrike, they did that, right? You see that? Now the problem with that is like you don't know when it's going to end. You're not going to know when it ends, really, right? The only way you're going to kind of know maybe is if you look at the smaller time frame charts, like. As long as this thing is acting like this, I guess, you know, this thing will keep going up. But yeah, you're gonna have to pay attention to it. I don't like playing something like this. If I get in, I have to always like watch what it's doing. I always have to be like, okay, I better put a trailing stop on it. Like if it drops like more than like 5% from the last high or something. But yeah, okay, you can go in. Let's see. What's the other one you said? HYLN. Okay, let's see. This one had very little volume before, huh? Very lightly traded stock, and then all of a sudden it starts doing this. Yeah, this is too risky. I would say this is way too risky here. This one's way worse than the other one. At least the other one is in some kind of like a trend. This one's not. And the volume is coming in at different points, right? So you could get trapped where like once the volume comes in and then it dies out, then somebody will come in and try to push it back down pretty easily. If the volume starts dying away, then this is easy to manipulate back down towards here, towards $4. So this is too dangerous. Yeah, for sure. This is way too dangerous. This one. That's just from a chart perspective and just looking at volumes. I don't know. If you know options, you probably can see it in a different light, right? You know, looking at charts today, I realized I could buy everything. These stocks kiss the daily moving and so we're having to trade. I mean, that is trading. That is trading anyway. Yeah, that is still trading though. like you're not trading in and out though, right? If you're trading in and out without a plan, that's a problem, right? Because the thing is like you have to look at it on all the time frames, right? Look at Micron. Look at Micron. Look at the weekly. The weekly is in a trend. We've been in a trend since July of 2025, pretty much right here. This is when the trend started. Because once we broke out of this range here, because you can see the range started in August of 2024, we broke out, we tested it in July. We broke out in June, right? We tested it in July, and then we started coming back up. Then when you got to September, you got a confirmation that you're going to go up because the moving averages started on the weekly, started spreading apart here and went parallel. So the trend of Micron has always been up. The question is like, when does it take a break? See here, you took a little break here, a little pause here in November. Here, you got a longer pause from January until the Iran war. And then we got like the taco trade, and then it pushed it up again. So it went sideways and we pushed it up again, right? Now, if you look at the smaller time frame, we look at the daily, right? Then you go like, well, all right, based on this, what should I do? And then you go be like, yeah, I'll get in here, somewhere here, right? Somewhere here where like the ADX here, the green 80 line, the DI line or whatever, it starts going up like crazy. Then you go like, oh, this is good. We're on a trend here. So September, you might look at this and be like, September is a great time for me to test this thing out, and I just buy and hold and keep going until this thing breaks. Once it breaks, I get out. All right. So I get out here. I wait for it. I wait for it. I wait for it. Then it recovers, right? You go higher than here. And you go like, well, let me get back in. So you don't even need to wait. Like you kind of go like, well, I wait for a breakout. I jump in. I ride it. Wait for it to like collapse. And I go like, okay, it collapsed here. It went below the moving average on the daily. I get out. And then you get out. And then you go like, you wait for the time when it's ready to roll again. Over here, December, it pops, right? And then we get like this nice going. Yeah, we ride again. And then we get stuck here in January. We get stuck. And we go here. Okay, I can get out here. You can do it like that. You know, you can do it like that. You can get out here. Wait. Okay, this is a bad part here. You get here, you got trapped. You got trapped. You got here, you got faked out. You got faked out in earnings. So a lot of people, they jumped in just before earnings. You went like 1, 2, 3. How come it was pumping right into earnings? And then once you had earnings, you did this, and you're like, oh, you just rolled back down. You got trapped. This didn't work. If you just did that, this part here didn't work. Okay, and then you wait. Okay, here we got here. You got our Taco Tuesday on 14th. All right, go. And then you just wait. And then of course it didn't come back. It only came back to the moving average here. You wouldn't have gotten out. You would have stayed, and you would have just stayed in there. Right? That's it. Yeah, you could do it like that. I don't know. It's up to you. Yeah. Yeah, it's not guaranteed because it's not always a repeating pattern. That's right. The pattern kind of changes a little bit here and there. Yep, that's right. Yeah. So sometimes it works, sometimes it doesn't work, you know. You gotta look at it a little bit. But over time you'll get used to it. You start seeing like, oh, okay. You know, you start seeing little patterns repeat a little bit, and you kind of go like, oh, okay, I can kind of see it. And then once you get the little options knowledge in there, it's like, oh, okay, I get it now. Something's happening here with the options. I get it now. And then you can really play better and better. Like if you look at the semiconductor ETF, you see this on Tuesday, you see this huge volume spike. Once I saw this, I couldn't be bearish anymore. Like semiconductors is the most important sector in the market. It's driving the market in right now. And you saw this huge volume in the ETF. It tells you something. You're like, whoa. So the ETF is a great way to look at volume, okay? Because the ETF, a lot of people, they trade ETFs. They don't trade stocks anymore. So when you look at the ETF and you see the volume have this kind of like huge, massive spikes here and here, you have to go like, why is there such a huge volume? Okay. And then when you look at the way the price is moving after that, you're like, dude, if people were selling here, If they were trying to get out here, look at the response. Immediately, it goes up back into the range. It goes up back into like this range right here after 2 days. This one, immediately, within 1 day, it was already going back into the range. You have to be bullish. You have to be bullish. Yeah, you have to be bullish, man. Anyway, yeah. So hopefully you got that. Yeah. Hopefully you understand what I just said. All right. Okay, let's continue on. I have to finish all these other tickers that I have to cover from last week. Okay, here's a list of tickers. Let's go. Let's see. We had Deere, Walmart. All right, Walmart, WMT. Let's see what this one. Terrible crap. Okay, what is this now? All right, Walmart goes down. Let's see. The trend has been pretty solid since 2022, but we've had moments where we had turbulence, right? Here during 2025, during the tariff stuff, and we recovered. Here again, we have some problems. So it looks like Walmart will again have issues. I'm not sure how long this will last, but this must be a range now. We had too many chances of it to recover over here, but we failed. So Walmart will probably be in a long range between 118 and 134 for the foreseeable future. How about Deere? Deere, this is one of my favorite industrials. It's right back to the top of May of 2025. So it gave up what it got in earnings on February. Okay, so the latest earnings have pretty much confirmed that it has to stay in this range for a while. So this will be the top. So either we'll have a huge range where we go between 441 and 673, or maybe we'll just go between this area at 534 to 673. I don't know, but I'll be watching this one to see where you want to get back in, because I think this will continue, but it just won't continue in the coming months. We'll have to wait for October probably. All right, Home Depot. Home Depot actually recovered. So this is one of the worst performing consumer discretionary stocks. So home improvement and real estate stocks that have to do with real estate constructions. I mean, not the real estate investment stuff. I'm talking about real estate construction, home building, and home improvement. So that side of the equation has been doing badly. They don't like interest rates. All right, they're very sensitive to interest rates. So certain sectors like biotech are going to be sensitive interest rates, and home construction is definitely sensitive to loans. So home building, home improvement, a lot of people take out credit lines to basically try to do home improvement too. So Home Depot will give you credit cards and shit. That's part of it as well. All right, so Lowe's, same thing. Let's see, Lowe's also had earnings. Terrible. I guess this is still down. Home Depot. Yeah, this stuff, they're all in a bad state right now. All in a bad state. That's all I can say. All right, Target. Target. All right. Looks like it's trying to recover, but I don't know. This is not really confirming it. I don't know what to say about this one. All right, TJ Maxx. Let's see. It's a trend, good trend. TJ Maxx still good. So TJX still doing good. All right, so let's look at another one. Toll Brothers. This is home building. Looks like it's trying to defend this area. All right. I don't know if that means I want to buy it though. So TOL, no, I don't think so. ELF makeup, nope. You remember I talked about this stock as a great one to short. You have this huge dome here, and then you're doing this. If this thing, like if this thing wants to break down, yeah, you're done. You're gone. If this thing doesn't like go back you're gonna be toast if you can't stay within that range of 54.93. Okay, guys. Yeah, that's it. Oh man, yeah, man, yeah. Fertilizer hasn't done much either. Yeah, that's true. Yeah, none of these things have done much. I don't know. Yeah, you guys gonna have to figure it out. Yeah, you guys have to figure it out. Okay, what's this one? Hasbro. Nope, guess not either. Damn. All right. Man, is this a range? Maybe. Okay. All right, let's see. Keysight. Keysight is kind of semiconductors related. Not really. It's a testing for semiconductors. It does. It's a split off from Hewlett Packard. Hewlett Packard split off between Agilent and Hewlett Packard did the computers. Agilent did the testing, and biotech. And then Agilent split between the biotech and Keysight. Keysight did electrical testing. Agilent did the bio testing. And then Hewlett Packard itself split between Hewlett Packard Computers and Hewlett Packard Enterprise. So it's split between 4 companies right now. So Hewlett Packard is 4 companies. Agilent, I think Agilent's ticker symbol is A. And then Keysight, Keys. And then HPE for Hewlett Packard Enterprise. Computing. Yeah, there you go. Okay, Baidu also had earnings. Let's see. Baidu. Yeah, Baidu right here. Not good after the whole news with China. Still. Billy. Chinese YouTube, terrible. Looks ugly too. I guess this is a range. You maybe if it goes below 15, you might go get it for a trade, but not much else. I mean, this thing looks ugly. I don't know what to say about Baidu. I don't know what the heck. I mean, this was a range down here, but what is this? Is this going to be a range? I mean, the thing with China, Chinese stocks are very tradable. They're very good to trade. They're just really crappy to invest. So Ray Dalio, I played the guys last week. Ray Dalio was the guy that kept pumping Chinese stocks, and it's just like, what the hell are you talking about? Chinese stocks are not good investments. They're good to trade, but investing, hell no. Oh, I don't know. Yeah. Oh man, this one. Oh my god, I can't even look at this one. This one's disgusting. IQ, QE, whatever it is. This is Webull. Look at Webull. What is this? Dude, what is that? That's crap. I can't even look at that. All right. Riri, is that Chinese? I don't know, maybe. I don't even know what the heck I'm looking at here either. No, can't recommend this. Okay, Ross, Dress for Less. Ross, see? We were talking about Ross like 2 weeks ago. We were like, Ross, that chart looks great. Look at that. Ross, the trend continues. We went down with Iran for some reason, and thank you earnings, we're right back up again. So Ross, good investment right there. Okay, let's look at the software stuff. Oh, Workday. Nothing. Looks like the earnings didn't confirm anything there. Take-Two Interactive. Didn't they talk about GTA or something? I don't know, but whatever. I don't think they're gonna make it, right? Look at this. This thing is going back down. What is this thing? What is this thing doing? Like, I'm just gonna draw lines here. I see levels. I see a 188 level. I see a 212 level, and I see a 243 level. If we break 212, I guess you can get it at 188. I don't know. This looks like nothing to me that I could figure out. Okay, Futu. So I read the articles with the Chinese stocks most affected by the new policies. I was tempted to buy this at the dip here. You know, this is really tradable. I'm not telling you guys like you should buy it to invest. I'm just saying like Chinese stocks, very tradable because you can trade on news, man. Like here, like in 2022, you could buy here let it go up for a bit. So you could have bought it at like 21, go up to 64, get out. You know, here you could just buy it here. You know, at 78, 107, you could probably get out back at 160 down the line. I don't know. I would be looking at this stuff for a trade. I could trade this for sure. This is definitely tradable. This is definitely tradable. Yeah, this is definitely tradable. You know, so watch these things. Maybe you could find something that a good price to settle down in the coming weeks, and then go like, yeah, I'll trade this. I'll trade this sucker. Yeah, see? Yeah, so bottom of this range going top. TIGR a little bit weirder. This one could actually fall lower to 2 something. Maybe you could trade it from there, go back up to 10. Yeah, don't need to put a lot of money into it. You could just figure out a good price, just trade it. Very volatile. Good thing to trade. So you guys already have NVTS and all this. Why not? You know, if you guys like risk, this is the place to be. Chinese stocks. All right, Pinduoduo. Pinduoduo owns Temu. Temu is the child company of Pinduoduo, PDD. All right, so it had earnings. I don't think we got much of a result from it. So let me see. It looks like it's trying to stay around this 96 area or 99 or whatever area. Like, I don't know. Let me see. Maybe something like this. Like, maybe it'll drop to 80, and then you could think about buying it, and then you could get out at like 160 or something. I don't know, because this kind of looks like it wants to do a range. Okay, because Temu is actually pretty profitable, but because it's Chinese, you know, the Chinese government can do all kinds of crazy crap to it. That's the risk of buying Chinese stocks. So if you want a little trade, yeah, maybe that's something you want to consider. All right, AutoZone. Ooh. So this was a good stock since COVID. I loved AutoZone. I loved O'Reilly. But ever since October of 2025, we've had big troubles with it. So it no longer is a long-term stock. If this thing breaks down here. If it doesn't break down here, what's going to happen is we're going to have a long range. Okay, $3,000 and $4,000 So this is a terrible range to be in, but yeah, this is huge. These 3 red bars, look at them. And very high volume on this last red bar. So that means if this thing bounces from here, that means a lot of people bought this. And what's going to happen is that, like, it's going to go up here. People are going to sell. It's going to go back down here, going to buy. It's going to go back and forth, back and forth. And because the range is so large, it's probably going to take years to figure this one out. So it's over. It's over. Here's another auto parts store. A crappy one. Advanced Auto Parts. Okay. So... yeah, what to say about this? Maybe it's going to recover, but it has a lot of headwinds right here. Like, if it's going to go up, you're going to slam your head right into the $90 and be like, zigzag, zigzag, zigzag over here. So, not really appealing. Sorry, not appealing. Okay, there's going to be 2 big earnings this week. Everpure and Dell. So these are going to be the AI stocks to watch, all right? Dell, we know Trump is in it. Everpure, a hot stock. I'm not sure what's going to happen in earnings, but we'll watch that. If these 2 and then Marvell, which is going to report Thursday. So if those stocks go down this week, then we're going to have a lot of problems, all right? The AI bubble might be in trouble for now. Into next week. So if you're looking for a dip, I'm guessing those 3 earnings will be important for you. All right. So that's the ones you're going to have to worry for. So let's look at Marvell quickly. So Marvell will be Thursday, I think, right? Dell is Wednesday. Shoot. That's Wednesday? Crap. Let me see. This one. What's this one? Thursday. Dell is Thursday. Okay. So that means tomorrow I got to worry. Oh, this one's Wednesday too. Oh crap. Okay, so maybe Thursday we'll have problems already. So all those are after the close Wednesday. So going into Thursday, maybe we'll see something. Maybe we'll see something exciting. How about that? All right, let me get the earnings whisper calendar here for you. Let's see. Okay. So Dick's Sporting Goods store tomorrow morning. That might be fun. SQM I gotta talk about next. Zscaler. Yeah, I'll talk about tomorrow probably. We don't got time today. See what else we got. Path. We got Weibo. Okay. HPQ. All right. Synopsys, Snowflake, CRM important for the software. So I don't know. They all got to report bad stuff. So whatever is going to report on Wednesday, let's see, Marvell, CRM, Snowflake, HPQ, Everpure, if all of them are bad. Nutanix also kind of important. So maybe if all of them report badly, oh yeah, sure. Maybe Thursday will be a dip. There you go. I mean, I'm not going to trust Trump to like cause a dip right away right now. We're going to have to wait till the end of the week probably for that, till Friday. Thursday, then we'll have Dell. So that means like Thursday after the close in Costco. And then that will be like Friday. That will affect whatever happens Friday. So yeah, maybe Thursday we'll see something if all those go down. All right, good. Okay, remove that. Go back to the chart. All right, done with that. Dell. Okay, so Israel. So Israel Defense Company, Elbit reported we got 11%. It's been going sideways since March. Okay, you see the monthly candles here. We've been going sideways. All the moves went into the Iran conflict. So we were going up to the Iran conflict. Once the Iran conflict, we tapered off. It already had earnings, though, today. So if we look at the weekly, what do you think? Do you think this thing has completed its move? Like, if we look at this like a range here, are we done? Are we ready to break out? So I told you guys that the Israelis are going to reduce their interest rates. So maybe this thing is ready to break out again, or maybe we'll just keep going zigzag. I don't know. I don't see a lot of volume here yet, right? So we don't know yet. We haven't completed the week, so I don't know if this is a very massive volume here that I should pay attention to. So is this important? Is this volume here important? You see the volume here? We had a huge amount of volume on this earnings, and then the next day we reversed it. And we started going lower and lower and lower. So this whole thing here was a false breakout. And then once we went below the range, we stayed in the range because now we just went down, right? So that was the problem. We started having a lot of trouble here. Now this thing here a reversal? I don't know. You tell me. That's something you got to figure out, right? So there you go. You got to guess that one. Hard to say. All right, Snow reporting earnings. We'll see how that one goes. Let's see how the weekly looks. Ugly chart. So can't tell you anything. If this thing goes up, then yeah, maybe it'll save all the software companies. Box, yeah, we got earnings. I guess we'll see what happens tomorrow. Okay. Box already reported. This one is going to report. Let me see. Okay. Yeah, tomorrow. SQM reported today, right? Okay, let's see. Tuesday. Yeah, Tuesday in the morning. So I guess no real result here. It's just 0.31%. So I don't know. So if you look at the other lithium stocks, so SQM is a lithium stock. You see this? So I'm kind of like, should you buy lithium right now? Maybe. So we pulled back. That's what I expected last week. So that's good. And SGML is my favorite. SGML pulled back a lot. It pulled back right to here. You see? Right here. So this area, the bottom of November 2023, we hit the top. We came back. I think, yeah, you might want to try to buy this right now. SGML. Okay? If this is actually forming a range, you might want to start like buying a little bit. I don't know. If you're looking for long-term, something long-term, this is probably the lithium stock for you. All right, SGML. And then after that, look at LAR. Okay? This one might be also good, but it might be better to wait a little longer to see if this thing comes back to $8 again. And then SQM might be the third one, or somebody else. I don't know. SQM is a Chilean, so it's kind of risky. If the Chilean government starts doing stuff to the company, you might get a better dip sometime down the line. So it has a lot of effects when you have to deal with South American governments. Okay, South American governments are a lot more crazier than Trump. Trump is actually pretty stable compared to what South American governments usually say. All right, Zscaler. Zscaler, okay, reported earnings already. I think today. I'm not sure. We're gonna have to see what tomorrow holds. If this thing can hold, maybe buy some Zscaler. I don't know. Zscaler could actually rip up to like $300. Like, this is pretty strong bottoming here. Like, okay, go for Zscaler. Pony AI. Okay, I don't know. This one looks like trash. So sorry, I can't recommend this AI stock for you. Nope. So that's it. All right, we're done. Let me see. Did I cover every little stock that I wanted to cover? Let me see if I missed any. Keysight, Hasbro, Walmart. Okay, Lowe's, Target. Yes. All right, finally, I'm done. Yes. Okay, guys, that's it. That's all you need to see. So you can ask me if you want me to look further into a stock on this list that you care about. But it looks like Walmart is going to be in a range, and Deere, I don't think you need to buy it right now. I was waiting to see if we had something strong on earnings, but it looks like it's not confirmed. So last week we had earnings, but this week there's nothing happening right now. So I don't know if we're going to confirm this as the bottom of the range, or we're just going to roll back over into next month, and you're going to have a better price at $400, $440 for this one. Yeah, so that's how you got to look at it. You just got to look at it that way. TJ Maxx is good, though. Ross is good, though. So you got that. You got those two. Maybe this is ready to rock, continue on. So out of all the discretionary stocks, there's only two that look actually decent. Everybody else, like Nike, Lululemon, ELF, oh my God, look terrible. It looked terrible. So, yeah, I guess people are getting poor if they're going to go to Ross, right? People are getting broke. So that's why you get that pink salmon shirt from Ross. I go to Ross all the time. I mean, shit, dude. Hop back over to 40 SMA. What's that on the daily? On 18 on what? The daily? Well, you're looking at 78 minutes. Well, you're looking at the weekly. This one. Yeah. I mean, I think this is fine. That's why I was saying, like, if this is actually, I mean, the problem is I don't know. We'll have to wait for the rest of the week, I guess. Like, if you look at the daily, that's decent volume, but not the same volume as we got when we got the top, right? So if you look at the top, you have this, right? You got this whole action here. You got that volume here, right? But if you look closely, you got a lot of volume that went into this up here. So from that point on, when you look at it, there was a lot of selling here. It has to be tested again. So you could buy it. I suppose you could buy it now and then see if it moves up into next week, right? Next week, if we survive even this week, I don't know. And then you're gonna have to watch very carefully how it behaves over here once it gets up here, like very carefully, because this thing could just go up and just go back. Because yeah, we're getting close to June. We're getting close to June, man. Yeah, we're getting close to June. Okay. I kind of want to wait for June before you want to make any commitments. Everything else is good for trading, but if you want this to continue on upwards on the range here, because if we look at the monthly chart on this thing, right, we got very good. It's very good here, but you kind of want to wait for this thing to get back up here to be safe, right? The Joe Rabel way is like, oh well, I'm only gonna wait for this thing to get back up here, so this thing could just go zigzag, 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 and then this will take until September for me to even consider really buying it for long term. For short term, it's okay, right? For short term, you don't care. You could totally just buy it here and be like, I'll take a chance. If it breaks out, you know, I could just ride this for a little while before it crashes and burns right back down here in July. So there you go. So that kind of gives you an idea of what to do when you look at it on that in that sense. Because if you look at the monthly, it's too risky, right? To really consider because the trend here, you know, this thing could be very significant. This is like 3 candles that has gone in a wild way up and down, up and down, up and down, right? While you look at here, it's kind of like this was kind of like building energy with very small candles, right? You know, the bars here are huge. These are actually huge candles when you look at the full range of it. So you kind of want a compression of the range, a decrease in the volatility. Okay, so you kind of want this thing. You kind of want this thing to chill out a bit, you know, kind of like make this kind of decrease in the width of the range. Because if you look at Rocket Lab, that's what Rocket Lab did before it broke out. So Rocket Lab here, let's see, here, like you can see, like you can see the range started decreasing, right, in this area, right? So you can kind of see like, oh yeah, look, there's a huge range here because we kind of like are going up and down in this area, but there was a little mini range inside of the larger range, and there's another mini range inside of the larger range, right? So there was a lot of like, range compression, expansion, range compression, expansion. And then here you have another range here, expansion. I don't know. Are we going to go up? I don't know. But that's what you kind of want to see. So there you go. Yeah, that. But ESLT, yeah, I don't know. I don't really see that here. It's kind of like you got like a range compression here, January, expansion, and then now you kind of going like, okay, you got a little compression here, then you went down, and then you just kept going down. That's not good. So this doesn't really give me a lot of clues, right? It's like there's some volume here, but not a lot. Like there was a lot more volume up here when it was at the top. So I don't know if this is sustainable. Like there's enough energy to break out or no? Or is this just enough energy to get up to the top and then just come back down, right? So when you look at the volume, there's a lot different, right? Compared to here and here, in this area where just like this has less volume. So yeah, that's what the Wyckoff guys would be looking at it that way. Yeah, I'm not buying Israeli stock for now. Fuck them. I know the market doesn't have more of the play. Yeah, plenty of other tickers, but it's good practice. You know, even if you don't buy it, you should study. You should study the tickers. like read them, right? You should just go and read and practice, and then go like, even if you don't trade it, go like, what do I think this stock is gonna do the next few days? You know, and then see if you're right. You know, that's good. You just practice your eyes, because when you quickly look at the stocks, so many stocks every day, you'll just quickly see the patterns in your eyes, and you'll be like flip, 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 and then yeah, you'll be done. And it's going to be great for you later on, to be able to quickly assess a stock when we get to the .com boom, bubble crazy market. We're not even there yet. You know, the market's not even that crazy yet. We crossed 0.5 on the 3-month minus 2-year yield, then pulled back right below it. Oh, okay. Okay, interesting. Yeah, we're close to the knife's edge, huh? Yeah, we're close to the end here of this of the danger. So we might see some really fun September October stock market crash. That'll be really fun. You'll buy the dip then. Everybody will be screaming that the market is going to die. So you're talking about this, huh? Oh, very interesting. Very interesting. Oh yeah, man. I can't wait. I can't wait for September then. September is going to be really fun. We're going to have a crazy good time. All right. Okay, let's see if I got another video for you guys. Let me see. So let's end this. I covered all the stocks. We covered everything. Great. Let's look at what we got here. Do I have another video? I think we're going to talk about tokenomics. Okay, we're going to talk about tokenomics, but first, do I have enough time? Hold on. Shoot, it's almost... Oh, man, no, I don't have enough time. Okay, maybe I'll save it for later. We're already at 2 hours, 30 minutes. I think we already got enough here. Okay, I'm going to talk tokenomics tomorrow. Some more token stuff. Google, the selfish ledger. So I'm going to talk about some concepts that people are taking from crypto and they're moving on to AI. So we're going to continue what I talked about on Friday. Okay, and Sam Altman said like he wants to charge you AI like a utility company. Okay, so the AI guys, they're ready. They're going to turn your lives upside down. Everything is setting up. Okay, you think Shaz is worth investing in? Yeah, the trend is okay, but it's kind of like it's trying to make a range right now. Last time I saw it, I don't know. Maybe I'll look at it again tomorrow, see how the action is. Probably not really safe. I think Micron is better, Intel is better, you know, to gamble on right now, and Hut and whatever, all those guys for this week. Everything else safe for next week. We just don't know what's going to happen on Thursday with all these earnings. All right.